Welcome back to the Retire Young radio show. I am your host, Joshua David, combating financial illiteracy. Also, don't forget to subscribe to the Retire Young podcast on Apple Podcast, iHeartRadio, and Spotify. Al, as we get into this next segment, I want to talk more about, as I mentioned in the last segment, is multiple streams of income. The smart money always has multiple streams of income, and the public or the average investor wants to know and understand how they are doing that. So let's talk about that. How is the smart money creating multiple sources of income using the stock market, but they're also utilizing a couple other assets along with that? And I also want to continue this discussion on how the market really moves, and it's based off of supply and demand, Al.
Yeah, let's start first of all, but why is it important to have multiple sources of income? Why do the big players, the smart money, why do they do that? Well, because one source of income may not always provide the income that you need. Maybe one part of the financial world isn't functioning very well during a particular period of time. There are others that you can fall back on.
Yeah, so what is income? What does that really consider? How does that really work? It's basically the net result of, a trade or investment.
Yep.
Minus the commissions, right?
Exactly. And it's typically a short-term type of a trade. Just because of the word income, it really kind of means that it's something that you need now. It's something to cover maybe your immediate needs as opposed to building up for wealth or retirement. Now, there's really different ways of investing for both. But I think it's really important that everybody, no matter at what stage you're in, knows how to generate income, how to generate additional income, because you use that while you're building your wealth, while you're accumulating assets, while you're working. And then also you want to use that when you're retired to just learn how to generate income off of the assets that you've accumulated over your working years. So it's really important to be proficient and confident in using different assets and different strategies. That's what the smart money is doing. Unfortunately, they're doing it themselves and not telling or counseling their clients on how to do it. So what we're talking about is, for the clients, Wall Street typically puts them in a mutual fund or some kind of a grouping with maybe thousands of other people. But what are they doing? They're not trading mutual funds. They are trading stocks, individual stocks. They'll put together portfolios and they will recommend that to their clients. But they're also trading in the futures market, in the foreign exchange market, in the options market. And there's a lot of benefits that they derive from those, one being leverage. We basically call them leveraged assets. And it's the kind of the financial market equivalent of a mortgage on a home. You have a down payment. You're not putting up 100% of the capital. You put a down payment down, a small part of the total investment, and the brokers will allow you to do that. Really, it's a way for you to maximize the value of your dollars. It is simply using smaller amounts of capital to control larger investments instead of putting up 100%, as I mentioned. And the main purpose there is just to be more capital efficient. The great thing for us as the public or individual traders is it allows people that might not normally have been able to put together, say, multiple positions in some of these very expensive stocks. It allows them to participate in the different markets. It can be in the stock market. With futures, for example, you can trade in the stock markets, whether it's the Dow, the NASDAQ, the Russell, the S&P 500, some foreign markets. You can trade commodities, currencies, interest rates, precious metals.
What's my favorite?
Lean hogs.
Lean hogs.
Lean hogs. I don't know if something happened to you as a child where lean hogs have become like your favorite thing.
I have no clue.
Someday we'll have to talk about that. But that is part of the futures market. And the great thing there is that you get true diversification. Most people are put into what Wall Street will tell you is a diversified portfolio. So you might have some large cap stocks, some small cap stocks, maybe some growth stocks, some value stocks, maybe some international stocks. The problem is you're diversified within one asset class.
They are all stock.
They're all stock, and that one asset class becomes highly correlated when we go through corrections or bear markets. In other words, pretty much everything gets sucked down with the good companies get taken down with the bad ones. And that's the problem with that kind of diversification. To be properly diversified, and this is one of the mistakes people make, is not being properly diversified. you should be in assets that are not all correlated to each other. The futures market provides that just all in one asset category. And then you've got the foreign exchange market, which really allows you to participate kind of in the global markets using currencies. And basically, you're trading one currency against another one. You trade it as a pair. Both futures and Forex are open essentially 24 hours a day. They have great leverage, maybe anywhere from 20 to 50 to 100 to 1 leverage, which means every dollar, for example, that is invested can control as much as maybe $50 worth of an investment. That is maximizing the value of your money.
Now, think about this. I mean, you went through just as far as the leverage, how that really works. You really defined that for our listeners. Now, to shed some light on that, if you look at Apple, that's running roughly $115 a share. So anybody that wants to purchase that has to have $116 per one share. Now, say they want to buy 100 shares of that, 1,000 shares of that. I mean, but the problem there is it ties up all of the capital. And that's why it's so important to understand these leveraged assets, to utilize that buying power, but really do that with confidence. And that's the thing. That's the key, is having confidence doing that. Now, Al, I mentioned one of those C words. It's confidence. Now, you help a lot of people gain that confidence in these other assets because, I mean, we talk to, thousands of people really, and most people want to learn how to trade the stock market because that is what we're told. We're told to go invest in stocks. And who's telling us these things? TV, the brokers, the smart money. They're telling us to do things that they're not doing. How do you help people with the confidence getting into something that's not new? It's just a little bit different.
Yeah, well, there's always a fear of doing something that you don't understand, that you've never used before. And one of the reasons that Wall Street doesn't put their clients, for the most part, into the assets that we're talking about, some of these leveraged assets, the shorter term assets, is primarily because they are used short term, which means that it requires too much time. If a financial advisor has 200, 300, 400 clients, it's almost impossible for them to handle an individual portfolio for each person that might require getting into and out of a position on a daily basis or weekly basis.
I would guess they can't even look at all their clients' names if they have that many in one day.
Well,
think about that.
That's
if they got hundreds
correct.
of clients, they don't even know who they are.
No. So what's the easiest way for them to handle a large number of clients like that is to put everybody into something that's managed by somebody else. In other words, a mutual fund. That's the typical go-to asset. And one of the reasons is because it pays great commissions. Mutual funds pay very good commissions compared to an individual stock, because a lot of companies don't charge any commission for stocks. The same thing with exchange-traded funds, ETFs. The payout on those is very minimal compared to mutual funds. So there's some self-interest there in using mutual funds, both from a fact that you don't have to manage them on a daily or weekly or monthly basis. Somebody else is doing that. And you also are getting paid more money to provide those or put your clients in those. So the fear comes again from not knowing what you're doing. So education is a huge part of it. In any proper education should really help with controlling the emotional impact of decision making. That's a big part of what gets in the way of people getting where they want to go in these markets. So how do you do that? By following a strategy, a core foundational strategy, ours happens to be called core strategy. But that
surprise.
Yeah, that's a good choice of words. And that really is kind of a timing mechanism, but it also has a set of rules. It's a step-by-step process that you follow. To control emotions, you have to take as much as possible the thinking out of it, and then do that step-by-step, more of a methodical, kind of an objective strategy where you're following something that has been shown to work on a consistent basis. Also, start with a small position. A lot of people, one of the problems they make is they open an account and then they just start throwing large amounts of money at a position thinking it's going to work out. We have our students start very small. In fact, do demo trading first. Learn how to achieve consistency instead of looking for those large profits. So start small. And then emphasize not just picking winners, but staying out of losers. That's every bit as important. It's not how much you make that counts. It's how much you keep. But having the right knowledge, understanding the right assets. Maybe there's an asset that is appropriate for each individual in a different market condition that might be different than your neighbor, for example. There are a number of different strategies that can be used in up markets, in down markets, and in sideways markets. You mentioned having a position in Apple. If you put together, say, 100-share position in Apple, and you're looking at maybe $11,000, $12,000 for that position, what has to happen for you to benefit? It has to go up in value. That doesn't always go up in value. They move around. They go up, they go down. Sometimes during a correction or a bear market, it might go down 40 or 50%. And you're only participating if it goes in one direction. So some of the strategies that should be part of proper education should be, how do you benefit? How do you participate in a market if it's going down in addition to up? How about sideways? Same thing.
So what is the concept for participating in a down market?
Well, there's really three primary ways to do that. One is called shorting. You don't even have to own something to participate in a down market. With shorting, you're basically borrowing something from a broker out of kind of their vault. For example, if it's IBM, you're borrowing shares of IBM that you then sell, or they're sold for you. And your goal and your hope is that it goes down in value. Let's say you sell something for $100 a share. It goes down, and you're able to go out and buy it at $100 and then return it. If you sell it at $200, I should say, and then buy it back at $100, you got a $100 profit there. You've borrowed it, so you have to return it, which means at some point in time you have to buy it, and you're hoping you can buy that at a lower price. That's shorting.
Yeah, I'm really glad you explained it that way, because I was completely lost. And a lot of our listeners probably were too. And now think about this. The concept makes no sense at all.
Right.
You're borrowing something you don't own. Think of it this way. If you buy and price goes up, that difference is the profit. You can actually sell first when price is high and buy it back to close at a lower price. That difference between there is also the profit. So to make things simple, instead of buying low, selling high, you're selling high and buying low. It's just the total opposite. Right. And to make it simple, that's exactly how that really works. So, and Al, you give more examples in these investing classes about what shorting is, how the futures market really works, the Forex market. I mean, the great thing about these markets is they're 24 hours. So think about that. If you work during the day, you can still participate in the evening. Why? Because it's actually still open. The stock market, that's only open 6.5 hours per day are in the U.S. here. So, in these classes, you talk more about that step-by-step rules-based strategy you were mentioning as well, really trading any asset class in any market. But the key that you're really talking about is how to buy at wholesale and sell at a retail price. Al, there's that one topic that I want to discuss in the next segment, and that's retirement. It's one of those things where everybody is striving for, and everybody wants to strive for really to do that on their own terms. So let's talk about why the smart money is doing things a little bit differently than the public in their investing strategies, but also how we can, as average investors, do that same thing that they're doing. This is Josh and Al. We'll be right back.